Welcome back to Cheddar's opening bell, everyone. Today is a big one for Wall Street with several blue chip companies reporting their second quarter earnings. And joining me now for more insight is Thomas Hayes, chairman of Great Hill Capital. Thanks for joining us. Let's talk cars first. GM reporting earnings this morning, and we know the numbers fell short of Wall Street's estimates, with its second quarter net income falling 40% from a year ago. And GM has been hit by the global shortage of chips and parts like basically every other automaker. So are the numbers disappointing but expected for GM?
I think so, Asia. Disappointing in the short term, but it was outside of their control. They weren't able to deliver 100,000 vehicles because of the chip shortage. That's the bad news. The good news is they maintained their full year guidance. They expect production to ramp up materially in the second half, which is going to be critical. And we know that those chips are coming because we saw Taiwan Semiconductor just over a week ago. Their auto chip business was up 16% year on year. And we saw NXPI Semiconductor last night, their auto chip business was up 36%. So despite the shutdowns in China in Q2 and some of the short-term headwinds for the auto industry, those chips are coming. IHS recently maintained their estimates for 2022 for 80 million global car sales for the full year 2022. So the expectation in the industry is there will be enough chips to deliver that, and the car production for GM is going to still rise 25 to 30% over last year, which is really good news.
Yeah, and full year guidance. I feel like guidance is everything these days in an earnings report. You mentioned that being good with production seeming to start ramping up for GM in the future. I want to take a look at the stock just really quickly for investors. It is down fractionally in pre-market about 1.25%. But you mentioned being able to meet these battery components, the battery materials to start building 1 million EVs per year starting in 2025 for GM. It still trails behind Tesla in that space, but does this news still give GM an edge over other rivals in the legacy space? We're talking about the Fords of the world, Hyundai, and those are outselling GM at this point.
Yeah, well, the good news is they got the batteries. The question is, will anyone buy them? I mean, the ultimate question is, do people want EVs or do they want Teslas? And that's a question that is still unclear, because if you look at market share, Mary Barra is taking a $30 billion bet that people are going to want EVs from GM, but Tesla still has 66% of US market share. GM has just 6%. So they've got a long way to go before they can be a credible player in the EV, but they're taking all the right steps. And in some sense, they're betting the company's future on it. So we'll see how that plays out.
Yeah, really good points there. Let's switch gears, though, to big tech. Alphabet and Microsoft kicking off the action today, reporting earnings after the bell. Investors in both companies are really hurting this year. I feel like that's the understatement. Alphabet down 25%, Microsoft slid 23%. What do you think Wall Street and investors are expecting from these companies?
Well, it's really all about the cloud. People are worried about ad spend as it relates to Google, as it relates to Meta, because of what we saw with Snap. I think what we're going to see is what Goldman Sachs said, that the ad spend with Snap was idiosyncratic. It's a much lower demographic, whereas Google has a more solid business on that front. But looking forward, we want to see that the corporate spending is up. If you look at AWS, for instance, their top 20 customers, Netflix, Snap, Spotify, Pinterest, Meta, these companies are all kind of struggling a little bit in a slower growth environment. So we have to see that spending maintained higher. And we want to see that from Azure tonight, which is critical for Microsoft. We want to see that from Google Cloud. And we want to make sure, as it relates to Alphabet, that the spending was up, particularly from search, which should be less impacted than the display ads from Meta and the ads that we saw in Snap last week.
Is there anything that you're focusing on in terms of factors for both Alphabet and Microsoft? I think with Microsoft, we know they've seen an incremental slowdown in their intelligent cloud business over the past few quarters. Now it's been, I think Q1 was 30% and just a few percentage points every quarter since. Alphabet has a similar situation, but they're expecting growth. How impactful do you expect those branches of their businesses to be in these earnings reports with all of the other headwinds facing both companies?
Yeah, I think for Microsoft, we need to see three things. First is Azure needs to be strong, okay, to allay investors' fears for corporate spending. They're looking for 47% growth in constant currency. The second thing that people are worried about with PC shipments declining so dramatically in the quarter is Microsoft needs to de-risk the outlook as it relates to FX, foreign exchange. The US dollar has been very strong. That's going to impact their earnings. The PC decline and a weakening consumer. And then the third thing is Microsoft needs to maintain that guidance, like you pointed to. That's going to be critical moving forward for investors' confidence. If they can maintain the guidance, I think we could finally get a bid here after some struggle. As it relates to the Google, there are three things affecting advertising. One is the Apple privacy, the iOS system. Are they working around that satisfactorily? Unlike Snap, who was really hit by the new iOS and the privacy policies. Advertising budgets. The Fed has induced a slowdown here. Is that ad spending retaining its previous heights? We're going to find out tonight. And competition for ad dollars. So TikTok really took a bite into Snapchat. Will it have the same impact on Google and Meta? We're going to find out, but I think we're going to see that the demographic is a little bit older and it will have less of an impact than we saw last week.
Are you anticipating any of these major companies debuting their earnings results this week to just avoid guidance altogether? Because we've seen with some of these companies, the strategy, I think with Microsoft recently, it was to preemptively warn investors like a month ago that we were going to miss on earnings. Are you anticipating to get no guidance from a lot of companies this earnings season?
Yeah, I mean, that would be the surest way to see your stock go down 10 or 15%. So I don't really anticipate it from some of the higher quality businesses. I think they are going to try to give some guidance. They may be very conservative, as Alphabet has had history in recent quarters of guiding extremely conservatively and then beating, and that would be a positive thing for the stock. So we expect to see guidance, even if conservative, from both Microsoft and from Google and from Facebook.
Okay. And any other bellwethers in terms of earnings that you're focusing on today that you think investors should be aware of?
Yeah, I think this week, I'm particularly focused this week on Meta and Amazon. If you look at the margin of safety going into the earnings, Snap got hit because they were trading at 30 times next year's earnings going into earnings. So when they missed, the stock got absolutely crushed. But Meta, on the other hand, is only trading at 12.5 times 2023 earnings, and Alphabet's trading at 16.5 times 2023 estimates. So, the estimates, the expectations are really low going into these prints. And I think that even if the numbers are a little bit soft or the guidance is soft and they sell off in the short term after earnings, when you look back 1 to 3 years from now, not owning Meta, not owning Amazon, which was down, almost 40%. That's happened only 7 times in the history of Amazon. It's always worked back up to new highs. I think this time will be no different. I think there's going to be a lot of regret for people not buying the Metas of the world and the Amazons of the world at these levels. This has just set up a great opportunity if you can take a 1 to 3 year view.
I also have to ask you about that word recession. We've had tons of guests on the show and more definitions about a technical recession versus a recession that actually gets officially announced. What is your case right now for where we're heading?
Well, I think there's so much pessimism in the market. If you remember the Bank of America Global Fund Manager survey last week, managers have the highest cash levels since 9/11. They have the highest recession fears since April of 2020 and March of 2009, both of which were bottoms in the market, anticipating the recession. So the best thing that could happen this week is that we get a negative GDP print for Q2, and rather than having to worry about the recession that's coming later this year or next year, we can look backwards and say we just had a technical recession. The market has discounted the large majority of it, if not all of it, and I think that could actually force some money back into the market for two reasons. One, they don't have to anticipate it, but two, it may set up the Fed to pause or decrease the pace of their rate hikes moving forward, which would be considered a pivot. And if you look at the 75 basis points that's probably coming tomorrow, That takes the Fed's funds rate to about 225 to 250, which was also the peak at the end of the last tightening cycle in 2019, which would be potentially the level that we top out at for this cycle as well, provided we did in fact hit that technical recession in Q1 and Q2. So I think bad news is going to be good news this week. And if we do get that negative print, you may see some serious money move back into the market.
All right, we'll wait to see if that is the case. That's Thomas Hayes, chairman of Great Hill Capital. So good to have you on the show. Thanks again.